Well, students, in the last lecture, we have completed the trading strategies involving options. And in this lecture, we will take up bounds for option prices. We will start our discussions with the simplest case, that is European options, where the underlying asset doesn't pay any dividend. In this case, the bound of the options can be obtained. Let us first obtain the bound of call options, and it is given by this theorem. So let's consider a European call option with strike K, and its expiration is at time t equal to capital T, and the premium is denoted by CE, where the letter C stands for call option and the superscript E is to say that this call option is of European style. And as I told you, the underlying asset, which is a stock, is not giving any dividend during this period 0 to capital T, and at t equal to 0, the spot price of the stock is S0. If all these are given to us, then you can say that the bound of the premium, that is the price of the option that one needs to pay to own the option, is given by this. You can see that the lower bound is the maximum of 0 and S0 minus K times e power minus RT, where R is the prevailing interest rate. Generally, we take it as a continuous compounding case. Otherwise, you know how to write the bound. But from now onwards, we will not worry about discrete compounding. We will only do continuous compound. So since it's a continuous compounding, its present value of K is given by this. And the upper bound is simply the spot price of the stock at t equal to 0. Let us see how to prove this theorem. Well, we assume that the market doesn't allow arbitrage. That is, we will be using no arbitrage principle, and therefore you more or less know how to prove this theorem. If you recall, we are already familiar with such ideas from forwards and futures. But still, we will do it in full details. First, let us prove this theorem for upper bound. That is, to prove that CE is less than or equal to S0. How generally we prove it? Assume the contrary, that CE is strictly greater than S0. Now, you construct a arbitrage portfolio in such a situation, and that will contradict the no arbitrage assumption. Well, what is meant by this assumption? It means that there is a K strike call option with price CE such that this condition is satisfied. Okay, so such a call option is existing in the market at t equal to 0. That is what this assumption says. Now, with the help of such a call option, let us build a arbitrage portfolio. So to build an arbitrage portfolio, we do the following trades. What you do is you short the K strike call option by the stock, that is the underlying stock in the spot market. So when you short the K strike call option, you will get rupees CE as the premium from the buyer of that option, because you are just selling it. Therefore, you get this money. Now you buy the stock in the stock market. Therefore, you actually spending S0. You see, CE, that is the premium that you got, is greater than the spot market price. That is the assumption you made. Therefore, when you got rupees CE, and you out of that, if you spend rupees S0, you will be left out with little money, that is CE minus S0. Okay, that will be a positive number because CE is greater than S0. That money you put in a riskless interest rate instrument. For instance, you can simply put it in your savings account. That way, you have built a portfolio. Let us just write this portfolio in the mathematical notations that we introduced. In the exam, I expect you to write the portfolio in this format. Here B is the riskless asset. So we invested in riskless asset. Therefore, we just assume that it is 1 unit. If you want to interpret it as bond, then 1 unit of the bond is this, that is the assumption. Or you simply put it in the savings account, then you can just consider it as 1 unit. Okay, so it is just an interpretation here. And you bought one stock in the spot market and you short one contract, which is a call option in our case, in the derivative market. Okay, so since it was a call, I just used the letter C here. So this is how our portfolio can be written mathematically. Now let us see what is the value of the portfolio pi naught. The value of the portfolio pi naught at t equal to 0 is denoted by this notation, and it is 1 unit into the price of that asset plus 1 unit of the price of the stock minus 1 unit into price of the option, which is CE, and you can see that everything get cancelled and you have 0. Therefore, the portfolio value at the time of creating it is 0. You just have to recall what is meant by arbitrage portfolio by definition. You go back to your notes, recall what is meant by arbitrage portfolio, and then come back and continue the lecture so that you will know what we are trying to prove in this theorem. So at t equal to 0, we got what we actually want for this portfolio to be an arbitrage. Now let us see what will happen at the expiration time, that is t equal to capital T. At t equal to capital T, we will have to make the following trades. What you do is you first settle the call option. Remember, you are a writer of the call option. Therefore, you have the obligation to execute it if your counterpart, that is the buyer of this option, wants to exercise this call. You have to supply the stock to the counterpart. Therefore, if the other person claims that he or she wants to buy the stock, then you have to supply it. But doesn't matter, at t equal to 0, you bought a stock and kept in your pocket. Therefore, if the counterpart wants to exercise the call option, you have the stock in hand, you can simply supply it. Okay. And now coming to this, when does the counterpart exercise this option? When the spot price is greater than the strike price, then it is profitable for your counterpart to exercise this option, because that person can buy from you for K and sell it in the spot market at ST and make a profit out of it. Therefore, they will surely come to exercise it. So if ST is greater than K, then you simply settle the call option by supplying the stock that you have already bought and kept with you at t equal to 0, right? If not, that is at the time t equal to capital T, suppose the spot price of the stock is less than the K that you have fixed in your call option, then your counterpart will not come to exercise it, because that person is not going to get any benefit out of doing that. Therefore, they will simply tear the call option and throw it in the dustbin and walk off. Okay. Therefore, whatever you bought, the stock in the spot market at t equal to 0 is yours. Okay. What you do is you simply sell it in the spot market and liquidate it. That is, you take the cash out of the stock. In any case, you will get either K. If ST is greater than K, then you will get rupees K by selling the stock to your counterpart. Otherwise, you will sell the stock at the spot market and get ST as the price. In any case, you have one of these with you. Then what you do is you also close your risk-free investment. So when you close your risk-free investment, how much you will get? Remember, you have put in your account CE minus S naught at t equal to 0. Now you are closing it at capital T. Therefore, in continuous compounding, you will be getting this much money from your risk-free investment. Let us see what is the total payoff that you got at t equal to capital T from the portfolio pi naught. The total payoff from the portfolio pi naught at t equal to capital T is the amount obtained from the risk-free investment plus the amount obtained from the call option by selling your stock either to your counterpart, that is this case, or directly in the spot market, which is this case. Okay. In both the cases, you can see that your payoff, that is the value of your portfolio at capital T, is strictly greater than 0. And what is the probability of having this? The probability is in fact 1. Why? Because the only randomness involved in this entire trade is in the spot price of the stock at capital T. This is only the random variable. All others are fixed numbers, right? And you can see here that it doesn't matter what is the value of ST, okay? Your portfolio value at capital T is going to be always greater than 0, right? Unless ST is negative, but throughout this course, we assume that the stock price cannot be negative, okay? That's an assumption. So with that, you have proved that pi naught is an arbitrage portfolio. This is a contradiction to our assumption that the market never allows arbitrage, that is no arbitrage principle. And how we arrived at this contradiction is because we assumed that CE is greater than S0. That made this term positive, and that is how we got a positive return, right? So therefore, this cannot happen. That is what it says. And that means CE should be always less than or equal to S0. This is what we are actually aiming to prove now. So that is done. Let us proceed to prove the lower bound. Recall that the bounds for CE is given like this. Out of this, we have already proved this, and we will now proceed to prove the lower bound. Here you can see that CE is always greater than or equal to 0. It cannot be negative because the buyer is given the luxury of not having the obligation to execute the option, right? Therefore, to enjoy this luxury, the buyer has to pay some money. Therefore, the premium has to be a non-negative number. In fact, more precisely, it should be some positive number. Having maximum of 0 comma something is justified there. So let us assume that S0 minus K e power minus RT is positive. If it is negative, then you know that maximum will pick up 0, and in which case you already know that it is true. Therefore, without loss of generality, we can assume this. And we have to show that S0 minus K e power minus RT is less than or equal to CE. This is what we have to show. Again, as usual, we will assume the contrary. S0 minus K e power minus RT is strictly greater than CE. And we have to arrive at a contradiction by showing that this will lead to a arbitrage portfolio. That is the usual idea that we have been using to prove many theorems now. We are familiar with this idea. Only thing is, in every case, you have to carefully choose your trades to build the suitable arbitrage portfolio. That is the only idea involved in all these theorems. Otherwise, the underlying idea is the same. So in the present case, we make the following trades. You short a stock in the spot market. So by doing this, what you get is the price of the stock, and then you buy one K strike call option. So what you will be paying to get this, the premium CE you will be paying. What remains is S0 minus CE. Now you can see from the given condition that S naught minus CE is greater than K times e to the power of minus RT, which is a positive number. Therefore, S naught minus CE is a positive number. That is what our assumption says. So this amount can therefore be invested in a risk-free interest rate instrument. In the worst case, you can just put it in a savings account. So this is the set of trades that we do and make the portfolio pi naught, which can be written in the mathematical notations like this: B, S, and C, right? Where B corresponds to the risk-free investment. Okay, so we will interpret it as 1 as we did in the last case. It means we will just think of that we are paying S naught minus CE as a price for your bond, and the unit is 1. So this is just an interpretation, and your stock portfolio is minus 1 because you have short the stock in the spot market, and the call option was bought. Therefore, this is plus 1. This is also plus 1. And what is the value? Is V of pi naught at t equal to 0 is 1 into S naught minus CE minus S naught plus CE, right? That is equal to 0. So this is all the idea behind constructing portfolio, right? Once you understand this idea, the other things are clear, right? Now let us see what is the value of the portfolio at the expiration time, capital T. At the expiration time, capital T, we may have to do the following trades in order to close our open positions. The first is close the risk-free investment. It means you just take away your money from your savings account and come to the call option. If the strike price is greater than K, then you exercise the call option. Why? Because this is the condition for call option to be exercised, and you are at the buyer side now. Therefore, you will go to your counterpart who is a writer and say, you give me, I want to buy the stock, you will say, right? Because it gives you right to buy the stock. So if ST is greater than K, you will go to your writer and buy the stock. Thereby, you will exercise the call option. If not, that is, if ST is less than or equal to K, then you will go to the spot market and buy the same stock from the spot market at the rate of ST per stock, right? Now you recall that you have also opened a short position in your spot market. Thereby, at some time, you have to close this position by buying back that stock, which you have done now. Well, how you have done it? It is slightly tricky. You see that if you would have bought it in the spot market, it means this short position is automatically closed. On the other hand, if you would have executed your call option, it means you bought the stock through your call option, then the spot market short position is not closed automatically. What you do is you take this stock, sell it in the spot market, take that money and again buy it in the spot market, and thereby you will close this position. Okay, so in any case, you can close this position by somehow managing with the stock that you are obtaining from your call option. That is more important to understand. So by doing all this, what you have in your hand as the payoff of the portfolio pi naught at t equal to capital T, let us see it. The payoff is nothing but the money that you obtained from your savings account, plus if you would have executed your call option, it means you would have paid the strike price and got the stock, or else you would have paid the current market price in the spot market to get that stock in order to close your short position in the spot market, right? So therefore, the sum of these two terms is the payoff for your portfolio at capital T. Recall, we have assumed that S naught minus k e power minus r capital T is greater than CE. That means S naught minus CE into e power RT is greater than K. That is what this implies. Now compare this with your portfolio value. You can see that this term minus, you can see it is K or something less than K is what is coming here. Therefore, this is always greater than 0 thanks to this assumption, right? And again, you can see that this value that you obtained, non-zero value, is with probability 1. Again, the reason is same as what we saw in the previous case. Therefore, pi naught is a arbitrage portfolio. This is again a contradiction to our assumption that the market doesn't allow arbitrage. That is, no arbitrage principle is assumed. Okay. Therefore, this assumption is not possible. It means the reverse inequality is what is going to hold, right? That is here. The reverse inequality is going to hold. That is what we want to prove. And this completes the proof of our theorem on European call option for a no dividend paying stock. Next, we will obtain the bounds for the premium of an European put option on non-dividend paying stocks. Again, let's consider a put option with strike K period 0 to capital T, and premium now is denoted by capital T superscript E. Here P denotes that the premium is for put option, and the superscript E denotes that the option is of European style. We assume that the underlying stock is trading at S naught at the time of issuing, and it is not going to pay any dividend during the option period 0 to capital T. And we also assume that the market does not allow any arbitrage. Under these assumptions, we can say that the premium PE is bounded by these quantities, where we have taken the prevailing interest rate as R and it is continuously compounded. How to prove this theorem? Well, the idea is exactly the same as what we did in the previous theorem. So I will skip all the details, but I will only give you the traits that are required to build arbitrage portfolio in each case, that is for the upper bound as well as for the lower bound. The rest of the steps can be filled by you without any problem, I hope. So I will leave them as exercise. Let us first consider the upper bound. Assume the contrary, that PE is strictly greater than K e to the power of minus R capital T. Now this assumption should lead to the construction of a arbitrage portfolio where the trades can be given by first short the K strike put option. Thereby you will get the premium PE that you invest in a risk-free interest rate. For instance, you can simply put it in your savings account. You can write the portfolio in the mathematical notation and you can find its value at t equal to 0. You will see that its value is 0. Then you write the necessary trades that has to be made at t equal to capital T, that is at the expiration date of the put option. Then show that the payoff from the portfolio at t equal to capital T is strictly greater than 0, and convince that this is achieved without any randomness involved in it. That is, the probability of obtaining the payoff to be positive is 1. If you show all this, it means you have constructed the portfolio as an arbitrage portfolio. That is, the portfolio created by these trades, which we generally denote by pi naught, is an arbitrage portfolio. I leave it to you to do all these steps and that will complete the proof for the upper bound. And then let us take the lower bound. Again, assume the contrary, that k e power minus rt minus s naught is strictly greater than pe. Recall that before going into this step, you have to first argue that PE is always greater than or equal to 0 by saying that the buyer enjoys only the right but no obligation to exercise the put option at the expiration, and therefore he or she has to pay a non-negative price for that. In fact, it will be a positive number, and then you come to construct the arbitrage portfolio in this case. I will just give you the traits and leave it to you to complete the other steps. The traits are given by this. That is, borrow this money from the risk-free interest rate instrument. With that, you buy a stock in the spot market for the price S naught and buy one K strike put option, and thereby you will be paying PE. Therefore, whatever you borrowed from the risk-free instrument, you have paid in buying these two assets. Therefore, it's very clear that the portfolio created using these traits has initial value 0. Now at the expiration, you close this portfolio and see what is the payoff coming. You will see that the payoff is strictly greater than 0 and it happens with probability 1. And therefore, it will be an arbitrage portfolio. So I leave it to you again to complete this proof. This completes the proof of the theorem. Our next task is to remove our restriction on non-dividend paying stocks and establish the upper and lower bounds for the European option on dividend paying stocks. Again, consider European put or call option. Now we remove the no dividend restriction and say that the stock may pay dividend D naught at some time during the option period. Then the bounds are given like this. You can observe that the only difference between the bounds that we give here and the bounds we obtained in the case of no dividend paying is that there is a D naught term sitting in the lower and the upper bound. So you can clearly see the logic in why it is coming. In fact, you can also put a discount factor to D naught with the prevailing interest rate or continuously compounding, but I have not put it here. I hope you can prove this. The proof will be exactly like what we did in the previous theorems. So I'll leave the proof of these bounds as an exercise to you.